Now, before we dive deeper, let me speak to two distinct groups tuning in at this moment. Some of you are dedicated long-term physical holders. You're looking at this pullback and feeling optimistic. Right now in the comments, you're mentioning you're prepared to purchase more, perhaps even relaxing with some snacks as you observe the swings. Your horizon isn't day-to-day, it's weeks, months, or years ahead. To you, this price movement is mere distraction, a short-lived discount on genuine wealth. You're steadily building your metal holdings no matter the temporary manipulations in paper markets. And this breakdown simply reinforces your approach. Acquire physical assets, add during dips, and tune out the noise from futures trading. But others here are active short-term traders. You're tracking these key technical zones closely because you're entering and exiting trades frequently. You're handling leverage, setting stop losses, planning entries and exits carefully. For you, the intraday and daily fluctuations are crucial. The technical outline I'm sharing is designed to guide you through this turbulence without major losses. Both mindsets are legitimate. Figure out which one fits you and adjust your actions accordingly. So let's tie together what I outlined in our last discussion with the current situation. I pinpointed those precise technical markers. I noted that the 150-hour EMA would serve as initial support, and it held at first. The price rallied about 10% before renewed selling overwhelmed that level, clearing the way toward the 90-95 zone I had flagged. I warned that a breach there would target 86 or below. It gave way. We touched 86, and now we're sitting around 78. The projected path unfolded precisely as described. I also covered the potential outcomes from the Fed chair selection. I explained that if Trump chose Judy Shelton, gold and silver might see an unprecedented single-day surge, given her strong support for a gold standard. It would pose a serious challenge to the entire paper suppression system. But if he opted against Shelton and selected a more standard, or at least not Shelton-level disruptive candidate, the struggle would persist, leading to that 86 or lower target. Well, Trump went with Kevin Warsh, not Judy Shelton. Warsh isn't a typical pick like Powell or Yellen, but he's far from Shelton's radical stance. The non-Shelton scenario materialized, we struck 86 precisely, and then slid further to 78. The technical failure and the political decision aligned exactly as anticipated. Kevin Warsh isn't unfamiliar. He was a Federal Reserve governor from 2006 to 2011 and was involved during the 2008 financial turmoil. After departing the Fed, he's been among the sharpest critics of subsequent monetary strategies. He's consistently pointed out that QE drove up asset values, widened inequality, and mostly enriched financial players rather than the broader economy. He's called QE a form of reverse Robin Hood redistribution. He also labeled the inflation spike after 2020 as a clear policy error, not something inevitable. The key detail. Although Warsh now backs interest rate reductions, his perspective differs markedly from market expectations. He pushes for rate cuts paired with active balance sheet shrinkage, not endless liquidity injections. This creates a real problem. Markets are betting on lower rates, but without the same flood of liquidity seen in past cycles. That mix isn't supportive of over-leveraged positions, elevated stock multiples, or rallies fueled purely by easy money. Put simply, Trump seeks lower rates. Warsh insists on stricter balance sheet control. Markets are now digesting the possibility of rate easing without QE expansion. The days of automatic QE rescues are no longer assured, and that's finally being reflected in pricing. Yesterday's sharp decline kicked off as the odds of Kevin Warsh becoming the next Fed chair spiked dramatically. Gold, silver, and Bitcoin plunged. The dollar strengthened. This was fundamentally a policy-triggered shift, not purely a chart-based collapse. Now, turning to the physical side. While paper prices are being hammered, Shanghai spot silver is holding around $122.45 per troy ounce. COMEX is at $78. The Shanghai premium currently exceeds $44 per ounce, a staggering 56.83% markup over Western paper levels. Physical silver in Shanghai is trading at nearly 60% above COMEX. Let me repeat that, close to a 60% premium. When COMEX was at $86 earlier, the premium topped $30. Now COMEX has fallen further to 78, yet Shanghai remains firm at 122, pushing the premium up to $44. Why the expansion? This isn't driven by fleeting momentum, it's a battle of endurance. China doesn't require silver to skyrocket immediately, it only needs the gap to remain substantial. China avoids chaos, it avoids a sudden system reset, it avoids headlines about market breakdowns. All it requires is a consistent 19 to 20% premium over Western paper prices. Matching Western price drops doesn't signal frailty, it demonstrates restraint. Physical metal continues heading east. Paper battles itself. Gradual pressure outperforms sudden shocks. It's similar to angling. Pull in line steadily, release a bit, repeat. That's sufficient to highlight genuine physical tightness, quietly reduce available stocks, push COMEX to raise requirements, and allow paper markets to weaken gradually. And on that note about COMEX requirements, fresh update. COMEX has increased silver margins to roughly $52,000 per contract. That's over $10 per ounce just to maintain a position on a standard 5,000-ounce silver futures contract. What does this indicate? Higher cash demands or forced exits. Leverage gets squeezed. Fragile participants get cleared out. Paper market liquidity shrinks. Margin increases don't occur in stable, balanced conditions. They arise when volatility surges and broader risks escalate. This hits paper traders hard, not the physical market. As paper tightens, physical silver keeps transferring, settling, and vanishing. Reduced leverage means fewer artificial moves and greater strain on the fundamentals. The physical tightness is undeniable. Another 5.6% withdrawal from Shanghai vaults in just one day. The outflow persists rapidly. Silver settled at $125.40 on the Shanghai Futures Exchange. Gold closed at $5,197. An additional 26.94 metric tons of silver were pulled from SHFE vaults on Friday. Total SHFE silver stocks have now fallen to only 455 metric tons. That's about 14.6 million ounces. Vaults are emptying while paper prices collapse. Connect those points. Here's the key mid-discussion insight that shifts the entire picture. While the West frets over Kevin Warsh and offloads paper holdings, examine the physical reality. The Shanghai premium widened from over $30, when COMEX was at $86, to $44 at 78 COMEX. COMEX fell $8, but the premium rose by $14. That's not fear-driven liquidation in China, that's deliberate buying. China is permitting the West to tank the paper price while they accumulate physical metal at whatever level is available. And it's not only private buyers. Governments are recognizing the shortage. The Czech foreign minister is traveling to the U.S. to address critical minerals. Silver isn't merely an asset class anymore. It's a vital industrial resource. And vital resources get discussed at high levels when supply tightens, not when it's plentiful. When governments begin focusing on supply chain resilience, when critical minerals turn into matters of national security, it's beyond technical patterns or paper quotes. It's about actual physical access. Paper can be printed limitlessly. Physical silver cannot. The Czech foreign minister's trip to the U.S. to talk critical minerals is no random event. It's evidence. Governments are realizing that China dominates physical supply, while the West remains caught up in paper speculation. We forecasted 86 or lower if Trump passed on Judy Shelton. He didn't do it. We reached 86 before dropping to 78. While the paper markets are collapsing, the physical supply is constricting into a matter of national defense. That's the gap that accumulators recognize. Accumulators aren't delusional, they're ahead of the curve. And China's approach is masterful. They avoid dramatic surges, they skip the spotlight. They simply maintain a steady 19 to 20% markup that silently empties Western reserves, prompts COMEX margin increases that erode paper trading volume, and establishes them as the real price determinant once the paper system erodes trust. That's the attrition battle. That's the extended strategy. And here's the twist. PPI inflation just exceeded forecasts. December's PPI hit 3% against predictions of 2.7%. Core PPI climbed unexpectedly to 3.3% versus 2.9%. Core PPI is now at its peak since July 2025. PPI is surging beyond estimates. And what occurred? Silver was sold off. Gold was sold off. The assets meant to protect against inflation were liquidated amid rising inflation news. Does that add up? No, unless you grasp that these are manipulated, artificial, deceptive arenas where values are imposed instead of revealed. Over years, the LBMA and COMEX have shown they're unable to manage an open and honest exchange. The last day is just an extension of those tactics, but it's more than tricks in precious metals. Similar schemes have kept copper undervalued, and a huge deficit is looming there as well. Equities are also deeply controlled. Values are dictated rather than found. But what if this is deliberate? What if the goal has always been to ruin smaller PM sellers with unbearable swings? What if the aim is to prime the bigger financial systems for a collapse that funnels control to the elite? You'll possess nothing and feel content. Have you pondered how that might happen? Well, you're seeing it happen live, in these totally fabricated, engineered, fixed systems. Now let's tackle the pessimistic view, since we touched 86 or below as I foresaw, and now we're at 78. The chart harm is genuine. We violated the 90 to 95 base. We struck the 86 or lower mark I highlighted. And the liquidation persisted, driving us to 78. If this force keeps up, more declines could follow. The trend is downward. The Fed leader choice wasn't Judy Shelton, the gold proponent we wanted. Trump selected Kevin Warsh instead. Warsh opposes QE. Markets expect stricter funding even with rate drops. That's negative for overborrowed items. PPI coming in strong shouldn't matter if the Fed shrinks its holdings. Inflation hotter than anticipated ought to boost gold and silver. But if funding is shrinking, near-term moves can stay negative. The paper arena can remain illogical and depressed longer than most participants can endure. If you're overextended, if you're using borrowed funds, this setup will ruin you. The COMEX margin boosts are meant to eject vulnerable players. They're succeeding. And here's another hazard. If Kevin Warsh truly pursues asset reduction alongside rate cuts, we might face extended tight funding that pressures all holdings, including metals. The QE period could truly end. That'd be a core system shift. Markets haven't factored a QE-free world in over 15 years. The shift might be harsh and drawn out. But here's why the negative paper outlook doesn't alter the positive physical one. Facts are approaching swiftly, and tangible items now hold choices. China has emerged as the hub for authentic silver physical value setting. That renders the completely bogus U.S. London paper systems obsolete fast. The vast divide between New York's paper rate and China's physical cost reveals everything. Such disparity can't last in a true market. We're in the final spasms of a grossly mishandled, debt-fueled currency setup. The Czech Republic is sending officials to the U.S. to talk about vital mineral logistics. That's not guesswork. That's authorities admitting resource shortages. Shanghai stocks fell 5.6% in a single day. 14.6 million ounces remain in SHFE holdings. COMEX raised margins to $52,000 per deal. These signal physical strain, not paper decline. China's plan is succeeding. Constant 19 to 20% markup, subtle buildup, compelled margin rises that destroy Western paper flow. And when the paper setup cracks, when the gap widens so much that arbitrage demands massive real transfers, China will dominate holdings and dictate values. That's the finale. That's what accumulators grasp that dealers overlook. So, where are we now? 3 main points and done. First, I outlined the precise chart points in our last clip, and they unfolded spot on. The 150-hour EMA resisted at first, with a 10% rebound, then gave way under sales, leading to the 90 to 95 support area. That failed, leading exactly to $86 as stated, and sales pushed further to 78 while recording. The chart guide I gave was spot on. If you're a quick trader, these points aid in handling swings. If you're a lasting accumulator, this fall is a purchase chance. Know your role. Second, Kevin Warsh as Fed head, not Judy Shelton, keeps the fight going, but the system is changing. Warsh seeks rate reductions with asset shrinkage, not endless QE. Markets are factoring the close of easy money times. That's negative for paper short term, but it confirms the extended argument for solid currency and durable goods. If QE ends for real, money dilution eases, but faith in fiat keeps fading. Physical triumphs regardless. Third, China's attrition conflict is effective. Shanghai markup now over 56%, $44 per ounce. Stocks dropping 5.6% daily. COMEX pushed to 52,000 margins per contract. Czech officials traveling to debate key mineral chains. This isn't daily values. This is physical access turning into national defense concerns. Paper can be created. Physical can't. China gets it. Accumulators get it. The paper dealers will learn it painfully. The open question is this. We reached 86 as predicted, then fell to 78. Does this base stick, or do we get one more drop before physical facts overpower paper control? And as China keeps emptying stocks at almost 6% daily, with the markup at 56%, how soon until Western supplies reach dire points and compel a value system shift? I predicted 86 or below if Trump skips Judy Shelton for a standard pick. and we touched that 86. Now at 78, with the markup surging to 56%. The chart points are happening. The physical basics shout shortage. The policy setup is moving from endless QE. And China is silently triumphing in the attrition war as the West argues over paper rates. This is the split. This is the chance. This is when you choose if you're building physical truth or dealing paper illusion. Do your research. Grasp the dangers. If you're leveraging trades, this instability is a destroyer. If you're accumulating physical long-term, this is the shakeout that makes historic buy moments. Time will show who got the strategy. Invest rationally, not excitedly.